So what's up guys, it's your boy Toxic and NK Forex, aka NK Forex. So today we will have a lot to talk about, and the first thing I want us to talk about is about the market profiling. So as a beginner, the first thing you want to understand in the market is what is the market profiling. So you want to understand the profiling on how the market is. You want to understand the key concepts about trading, because those are the things you'll be looking at as a beginner's trader. You have to understand the key concepts. You need to understand what trading is all about. And so I'm taking this section. So this section we are diving into some of the key concepts as a beginner and things you need to look out before going in for a strategy or before approaching the market in whatever strategy you choose to follow. That will be on you. So excuse me. So now we are about to start. Get yourself a cup of tea, a cup of coffee, or anything, and I will need your full focus on how we dive in on this part of the forex market. So now, talking about the market profiling, as you all can see, the market profiling is a technical analysis method organize price activity by time to identify the market balance, values, areas, institution trading activities. It uses tools like market profile and volume profile. Okay, now what does that mean? What do you understand by that? So basically, we are trying to tell, like, the basic thing you need to understand is the profiling of the market is just like a technical, like the technicality of the market. You get, is a market uptrend, is a market downtrend? What is the technicality? What are the things the market is showing you? That is the market profiling. The institution traders, things like that. So okay, so if we come down, if you come fast forward down, you're gonna see we have the type of market profiling. So as you can see, we have the bullish and the bearish market profiling, as the definition says. So now you see, in the bullish market profiling, you want to see price giving you higher highs, higher lows, higher highs, higher lows, higher highs. That means the market is going to the upside. That means the market is bullish. And you want to be seeing lower lows, lower highs, lower lows, lower highs, lower lows, lower highs. That means the market is going bearish. Now, what does bullish and bearish means? Because from the diagram, as a beginner, you might not know some of those words, bullish, bearish, but it just simply means the direction of which the market is going or the bias of which the market is going. So now, once you are able to identify the market profile, like you profile the market, when you go into your chart, the first thing, what do you want to do? You want to see the direction of the market. So you are profiling the market. You understand? So that is the market profiling. You want to see the overall direction. What is the market doing? That is you trying to anticipate on what you are going to be looking at in the market. So when now that you have understand that the highs and lows, the profiling and whatsoever, what all the rest things you're supposed to be looking at, what are the next things you want to look at? You also want to understand the market structures, the structures the market is giving you. So based on the structures the market is giving you, I'm still going to use part of the profiling to talk about the structure. So we have three types of structures in the market. We have the uptrend, we have the downtrend, and we have the accumulation. When the market is accumulating, as you can see here. So looking at this area of the market here, we have the accumulation. Now on the accumulation, you can see the market is not buying, the market is not selling, the market is just in a one position, just accumulating. And what do you want to do as a trader when you come across such market? When you come across such market, you want to stay out of the market and wait for the market to take liquidity from one side, then you follow with the other side. So for example, as you all can see, the market was accumulating here and the market collected liquidity and break to the downside. So we had the break to the downside. So definitely you wait for a pullback, breaker block, fair value gap, and you continue selling. So now, what is accumulation? What is accumulation? Accumulation in trading is a phase often followed a prolonged um, a prolonged downtrend where institution investors, smart money, quality buy assets create a sideways low volatility price range. Now, low volatility price range means the market is not buying, the market is not selling, it's just in a particular range, that's just it. So now we come down to one of the next topics, which is also talking about market structures. Okay, so now what is a market structure? The market structure is the entire structure of the market. As you can see, this is the structure. You have the lower highs, lower lows, lower highs, lower lows, lower highs, lower lows, and here you have the higher highs, higher lows, higher highs, higher lows. So it's just basically when the market shifts from a downtrend to an uptrend, the entire move is called a structure. So this now stands as the entire structure of the market. So this is what we call the market structure, because it talks now with the entire structure. Excuse me. Sorry about that. So now let us talk about the market structure. The market structure in trading is the analysis of price action, defining market direction through a sequence of swing highs and lows, identifying trend, and in act as a time frame, separating market into uptrend, higher highs, and downtrend, lower lows. Okay, so now based on the explanation, you are going to understand that now we are talking of when the market is changing from highs to lows, as I earlier said, and now we have the trend of the market. Sorry, we have the trend of the market that you are looking at. So after identifying that trend of the market that you are looking at, you want to know your higher highs, higher lows, where the market is breaking structures. Is it breaking structures to the upside? Is it breaking structures to the downside? You want to know the direction, you want to anticipate where the market is heading to and stuff like that. So that basically just deals with the market structures. Here we are going to be talking about the market structure shift, break of structures, and all the rest. So now, excuse me. So now imagine the market is giving you higher highs, higher lows, higher highs, higher lows, higher highs. That means the market is breaking the previous highs, giving those previous highs a break of structure. Now, what is a market structure shift? A market structure shift is used to identify when the market has changed the trend. So, for example, if we were going to the upside and you see the market breaking a protected low, that means the market has changed the direction from higher highs to lower highs. So now we no more be looking at higher highs, but we will be looking at lower highs, lower low, lower highs, lower low, lower highs, lower lows. So those are the things we need to understand, that as a trader you need to be ready to understand and learn all of those things, how to anticipate them in the market. So let's go fast forward to the next break of structures. I've explained, you can just read, but I give you to the best explanation in a way you're going to understand. So now there's what we call liquidity. Liquidity is one of the concepts in the market. Like it's something in the market that you need to must know what liquidity is. If you don't know what liquidity is, then you are going to be the liquidity of the market. So you have to be able to spot out where liquidity are sleeping in the market. So now, on the concept of liquidities, we have several liquidity zones. Each highs and lows are liquidity zones. So each low the market creates and each high the market creates is a liquidity zone. And now we have what we call external and internal range liquidities. Internal range liquidities are places like your fair value gap, your breaker block, your order block. However you approach the market, those are your internal range liquidities. Now, external range liquidities now are the break of structures, the lows, the highs. Those are external range of liquidity. So now, me as a CRT trader, which I'll be explaining to you how as a CRT trader I am able to identify my liquidity zones. I would just like to take you guys through sorry, I would just like to take you guys through the concept of liquidity. So as you earlier see, liquidity in forex refers to the excess with which a currency pair can be bought or sold without causing significant price fluctuation. High liquidity common in major pairs like Euro USD ensure spread and fast efficient execution. Now we will come to CRT, and on CRT I will give you people another example of liquidity. So I would like us to talk on the example of liquidity before we go back to the topic of what I'm about to say. Before we go into CRT, for now I want us to first of all talk on liquidity zones, and after that this is just a quick example to run you down on what liquidity are. So now every candle, be it on the daily time frame, the monthly time frame, the weekly time frame, each candle you see is a range. So when you see a candle range high and you see a candle range low, those are liquidity areas on the lower time frame. So now what am I trying to say? What I'm trying to say is every highs and lows in the market is a liquidity zone. That's what I'm trying to say. But now, how will you be able to use the CRT data soup to identify your liquidity areas in the market? First, you want to first of all understand what is CRT. So CRT stands for candle range theory. Now, CRT candle range theory is a trading concept that treats individual candlesticks as a complete trading range. Use their highs and lows to identify liquidity zones and potential reversal. It's it's uh it posits the highs or lows of a specific institutional candle saver. So now, what am I trying to say here, guys? What I'm trying to say is, with the use of the ranges, which is your highs and lows, those are liquidity areas in the market that you need to keep a good level of concentration to understand what is going on. So now, when we come, you have the various classification of CRT. You have the various classification of CRT here, which we have. There are three main classification of CRT. You have the bullish, you have the bearish, high time frame, structure, phase, blah 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 blah. But then we want to talk on the most important things, which is the bearish, the bullish, and the bearish direction. So now let's take for example the bullish CRT model used when the price is at a key high time frame support level. It involves the current candle dipping below the candle previous candle low, liquidity sweep before reversing to close above the low. So now let me show you an example. As you all can see, we have an example here. You can see the market dipping, collecting the liquidity, closing within the range, and the next candle coming all the way down to complete the CRT movement. So we have here sorry, we have here the bearish model. Just there's the similar thing with the bullish, but something is just a little change, because here you look from the bullish to the bearish. So it's when the price take a key level from the higher time frame resistance level, the current candle dips above and collect liquidity. So it's just the same thing. This is the bearish price collecting liquidity up and coming down. Then for the bullish, price is collecting liquidity down and going up. So it's just a similar thing, similar to the highs and lows. And now the most important thing you want to understand is the time frame, because time framing is very, very important. The time frame. So now the time frames you are supposed to be looking at your CRT. You have the higher time frame CRT. Use the daily, the weekly candles to define the range. High, low, that will be manipulated. Then the lower time frame, use the execution trader market a higher time frame. So the lower time frame is for you to, like, once you have identified your drawn liquidity based on your higher time frame, the lower time frame now is for execution. So if you have marked your range high, your range low, you want to come to the lower time frame, to start looking for entry models, liquidity, like internal range liquidities, where you'll be looking at your POI to enter your trade and stuff like that. So now let us go to the next. What is the next we have? Okay, so the next we have the phases. Now the phases is what we call the AMD. The AMD simply stands for the accumulation, manipulation, distribution. So after this, I will take you guys to the chart and we're gonna have a little talk on the chart. But for now, I just want to talk on few things about CRT that you might be interested in knowing, and things you would like to know about the candle range theory, or even just giving you a highlight or some one or two things you need to first of all start by understanding before you even come into trading. So the accumulation, manipulation, distribution is just like the phases of the market. As we earlier said up here, the market accumulates. This is when the market is not moving to the upside or to the downside. It's just in one position. That is the accumulating phase. And then the distribution phase is when the market finally takes a direction to go. And the manipulation phase, I'm gonna explain that when we get to the chart, so we're gonna understand that more better. Okay, so now as you all can see, we have the accumulation, manipulation, distribution, and that is what you want to know about the phases of the market. Just telling you how the market operates. And the liquidity target, you have previous candle range, you have previous day low and high, you have previous section low and high. So every section has liquidities, every daily candle has liquidities, every weekly candle has liquidity, every range in general has liquidities. So liquidity just deals with the highs, the lows, the section opening, section closing, and stuff like that. And here we have examples of CRT candles, because it's not just the classic 3 model. We have the 2 model, we have the 4 model, 5 model. So these are the various classes of CRT candles. I don't really want to talk much because not everybody is dealing with CRT. But then this is my book I'll be releasing soon. That is all about CRT from beginners to CRT pro level. But for now, I don't really want to talk much about CRT. I want to just give us a highlight on what we will be looking at in the market as a trader. So now, I would like us to come to our chart a bit and have a quick review about some certain things in the market. Okay, so looking at my chart right now, let it load.